There is a provision in the United States tax code that allows a business owner to purchase a $60,000 luxury SUV, drive it off the lot, and deduct the entire purchase price from their taxable business income in the same calendar year. Not over 5 years, not over 7 years. Through standard depreciation schedules, the entire amount in year one on day one. A $60,000 deduction that, for a business owner in the 37% federal bracket, represents $22,200 in immediate tax savings. The vehicle parks in their driveway. It takes their children to school. It sits in front of their house. And the United States government effectively subsidized between 30 and 40% of its purchase price through a tax code provision that has been in place since 1958 and that Congress has repeatedly expanded rather than restricted. The provision is Section 179 of the Internal Revenue Code, and the vehicle that became its most famous beneficiary, the one that gave this strategy its nickname in the financial independence community, is the Mercedes G-Wagon, a vehicle that weighs over 6,000 pounds and qualifies under a specific gross vehicle weight rating threshold that unlocks the full power of the deduction. But the G-Wagon is just the most glamorous example. The Range Rover, the Cadillac Escalade, the Lincoln Navigator, the Chevy Suburban, the Ford Expedition, the Ram 2500, and dozens of other vehicles that weigh more than 6,000 pounds at their gross vehicle weight rating all qualify for the same treatment. And the auto industry, which generates over $1 trillion in annual sales in the United States, has known about this threshold for decades, which is precisely why the luxury SUV market is designed the way it is. Welcome to the Invisible Ledger. If these stories matter to you, hit subscribe and the bell. This is where we trace the money they told you not to follow. Section 179 was enacted as part of the Internal Revenue Code revision of 1954 and became effective in its modern form in 1958. Its original purpose was to stimulate small business investment by allowing immediate expensing of equipment purchases rather than requiring businesses to depreciate assets over their useful lives. A small manufacturer who purchased a $50,000 lathe could deduct the entire cost in the year of purchase rather than taking $10,000 deductions over 5 years. The intent was to improve cash flow for small businesses and incentivize capital investment in productive assets. Over the decades, Congress has consistently expanded the Section 179 deduction limit. In 2003, the limit was raised from $25,000 to $100,000 as part of the Jobs and Growth Tax Relief Reconciliation Act. The Tax Cuts and Jobs Act of 2017 dramatically expanded it further, raising the base deduction limit to $1 million and indexing it for inflation. For tax year 2024, the Section 179 deduction limit is $1,190,000, with a phase-out beginning when total equipment purchases exceed $2,890,000. For most small business owners, the practical limit is the purchase price of the asset itself, because they are not buying enough equipment in a single year to approach the phase-out threshold. For passenger automobiles, however, Congress established separate limits specifically to prevent the provision from being used to deduct personal luxury cars. Under Section 280F, passenger automobiles are subject to luxury auto depreciation caps that limit the deduction to approximately $12,200 in the first year for vehicles placed in service in 2024. This is where the gross vehicle weight rating becomes the critical variable. Section 280F's limitations apply to passenger automobiles, which the IRS defines as any four-wheeled vehicle manufactured primarily for use on public streets with an unloaded gross vehicle weight of 6,000 pounds or less. Vehicles with a gross vehicle weight rating exceeding 6,000 pounds are not passenger automobiles under this definition. They are not subject to the luxury auto caps. They qualify for the full Section 179 deduction up to the $1 million limit, subject to business use percentage. Before I go further, this video is just the surface. Inside the Invisible Ledger Vault, you will find the complete Section 179 vehicle qualification list, the business use documentation requirements, the mileage log template required for audit defense, the bonus depreciation comparison for vehicles placed in service in 2024, and the state tax conformity chart showing which states follow federal Section 179 rules. The link is in the description. But stay right here. The mechanics of the deduction require genuine business use. Under Section 179 and the supporting regulations, a vehicle must be used more than 50% for business purposes to qualify at all. If business use is between 51 and 100%, the deduction is proportional to the business use percentage. A $75,000 SUV used 80% for business generates a deductible amount of $60,000. If business use falls to 50% or below, the vehicle does not qualify for Section 179 at all and reverts to standard luxury auto depreciation caps. The business use requirement is where the strategy requires discipline and documentation. The IRS does not accept estimates or general statements about business use. Treasury regulation. Section 1, 274-5 requires contemporaneous records, meaning a mileage log maintained on an ongoing basis, not reconstructed at tax time, that records the date of each business trip, the destination, the business purpose, and the number of miles driven. Without this log, the deduction is vulnerable in an audit. With it, the deduction is straightforwardly defensible. The types of business use that qualify include driving to client meetings, traveling to job sites, transporting business equipment or inventory, attending business conferences, driving to your business location from a separate home office, and any other travel directly connected to your trade or business. Commuting from home to a fixed regular workplace does not qualify and cannot be counted as business mileage. If your business involves visiting clients, properties, customers, or multiple work locations, your legitimate business mileage percentage can be substantial. The combination of Section 179 with the bonus depreciation provision under Section 168K creates additional flexibility. For vehicles placed in service in 2024, bonus depreciation allows an additional first-year deduction of 60% of the remaining basis after the Section 179 deduction is taken. For a vehicle that fully qualifies under Section 179, the deduction is typically taken entirely under Section 179 and bonus depreciation is not needed. But for vehicles that partially qualify due to mixed business and personal use, or for vehicles in excess of the Section 179 limit, bonus depreciation provides a supplemental mechanism. If you have made it this far, you already understand why the parking lots at luxury car dealerships look the way they do in December. Business owners across America are making vehicle purchases before December 31st specifically to capture the deduction in the current tax year. Subscribe and share this video. The revenue impact of this provision is significant and deliberate. According to the Joint Committee on Taxation, accelerated depreciation provisions, including Section 179, cost the federal government over $290 billion in revenue over a recent 10-year period. The auto industry has lobbied successfully for decades to maintain and expand these provisions because they directly subsidize vehicle purchases by business owners who would otherwise face higher after-tax costs. Now let me give you the exact steps. Step 1. Confirm that your vehicle qualifies. Check the manufacturer's specifications for the gross vehicle weight rating, which is printed on the door jamb label of virtually every vehicle. The rating must exceed 6,000 pounds. Common qualifying vehicles include the Chevrolet Suburban at 8,900 pounds GVWR, the Ford Expedition at 7,300 pounds, the Lincoln Navigator at 7,300 pounds, the Cadillac Escalade at 7,500 pounds, the Ram 1500 pickup at 6,800 to 7,100 pounds depending on configuration, and the Mercedes G-Wagon at 6,834 pounds. Step 2. Confirm that you have an active business. The vehicle must be purchased by or used in connection with a legitimate business. This can be a sole proprietorship, an LLC, an S corporation, a C corporation, or any other business entity. The business must be active and profit motivated. Step 3. Ensure the vehicle is purchased and placed in service before December 31st of the tax year in which you want to claim the deduction. Placing in service means the vehicle is available and ready for use in the business. It does not need to be used extensively before year end. Step 4. Begin your mileage log immediately. From the first day the vehicle is in business use, maintain a contemporaneous log of every trip, including date, destination, purpose, and mileage. Use a dedicated app or logbook. Step 5. Work with your CPA or tax professional to claim the Section 179 deduction on IRS Form 4562, which is filed with your business tax return. The deduction reduces your business income and flows through to your personal return if you operate as a pass-through entity. Step 6. Maintain the mileage documentation for at least 4 years after the tax return is filed. As this is within the IRS audit look-back period for returns involving large deductions. I need to be honest with you. This strategy has real requirements and limitations that prevent it from being a free luxury vehicle for everyone. First, you must have sufficient business income to absorb the deduction. Section 179 cannot create a loss at the entity level for most businesses. If your business earns $40,000 and you try to take a $60,000 Section 179 deduction, the deduction is limited to $40,000 and the excess is carried forward. Second, the 50% business use requirement is real and enforced. Claiming a vehicle as 100% business use when it is driven to soccer practice and on family vacations is tax fraud, and the IRS identifies this specific pattern in audit selection. Third, if the business use percentage drops below 50% in a future year, you may be required to recapture a portion of the deduction as income. This is called depreciation recapture. Fourth, some states do not conform to the federal Section 179 limits and have their own lower caps. California, for example, has historically limited its state Section 179 deduction to significantly lower amounts than the federal limit. If you operate in a high tax state, the state tax savings from the deduction may be less than the federal savings. And fifth, the vehicle must be used primarily for business. A deduction claimed on a vehicle that serves primarily personal purposes is not a gray area. It is fraud. Your grandparents who ran farms and small businesses understood that the tools of a trade were the tools of survival. The truck that hauled grain was not a luxury. The wagon that moved product was not a perk. It was how the business ran. And the tax system, even then, recognized that the cost of doing business was deductible against the income it generated. Then, one generation was told that business deductions were only for large corporations, that the tax code was too complex for ordinary business owners to navigate, and that anything that seemed too good to be true must be illegal. It is not illegal. It is Section 179. It has been in the code since 1958. And the number 6000 is printed on the door of the vehicle in the dealership parking lot. Subscribe and share this video. Every share puts the GVWR specification in front of a business owner who is about to buy a vehicle with after-tax money they did not need to spend. The next vault opens soon, and what is inside will show you the offshore structure that has survived every American court order, every federal judgment, and every creditor attorney who has tried to reach the assets inside it. Zach,